have been speaking with Rajiv Jain, the promoter, the chairman and chief investment officer at GQG Partners, the fund that bought a whopping 15,446 crore rupees of Adani Group shares earlier this month. Rajiv, thank you very much for your patience. Now, that amount of buying actually makes you the second largest shareholder in some of the Adani stocks, other than the promoter. So, do you have a dialogue with them? What do you want from them? What do you ask them? Because, there is clearly a perception issue. Most of the Indian mutual funds don't own Adani shares except what they have to buy because they are buying for index funds. So what would you advise them to do so that they have wider, purchase, wider funds?
Yeah, so look, I think it's not going to be the answer maybe you're looking for, which is that we actually don't try to engage on a day-to-day basis too much, because in this case there are some optical stuff which we feel that can be cleared up. In fact, they are being cleaned up as we talk over the last few months and years. So I think there's optical stuff and there's a substantive stuff. So from a substantive stuff, we feel that the reason why we are attracted to this group is their ability to execute very complex projects where in India there's a lot of headroom for. That's what I call about TAM. I mean the privatization, there's still 25 plus airports, they'll be privatized over the next X many years. Who do you think is in a position to even have these? I mean, others have tried, they're levered, they didn't turn out to be competent. So our view is that they need to keep pushing for growth while managing the debt level, which I think they've already done that. I mean, they announced some of the shelving of the project, so on and so forth. So I think it'll be a little more manageable from the debt perspective, although we are not concerned as at the current point from a debt side. But I think the objective is to keep growing. Look, I think it'll be a mistake to slow down to get the debt levels down. I think these businesses are supposed to be levered. That's the model. So debt has to be in a sort of in a measured way. However, our view is that don't change anything to please the markets, because in fact I'll tell you, even Reliance and Berkshire Hathaway, for example. I mean, Berkshire Hathaway went up without many investors owning that for decades. I mean, you'll be surprised. Do you know how many sell-side analysts even cover Berkshire? I think there are 2 analysts cover it now. For first 20 odd years that I looked at the stock, there was no sell-side coverage. No institutional investors owned Berkshire Hathaway. So I think there's a lot of history. I can tell you Korean name that we own without any sort of local institution support. So the question is, if they create value, the stock market will take care of itself. And that's what the focus should be.
Okay, fair point. Just to finish this conversation, did you approach them or did they approach you beginning March?
So we had actually begun to do work, as I mentioned before in some of the other calls, that we actually wanted to see from a banking exposure perspective how exposed we are. We have looked at the name. We met the management last summer, actually, when they were visiting New York. I mean, just regular roadshows. And as we did more work, we thought, this is kind of interesting. Same time, Jefferies approached us. I mean, he happened to be here in South Florida. So we talked to him, and that's how the conversation started. And we kept doing the work. Bulk of the work we've done is actually not talking to the management, by the way. That's just not our style. We do talk to them, but our view is that managements can only tell you certain stuff. We have to make a sort of educated guess where the business is going to be 5 years out, and do our own due diligence in terms of the allegations made now are legit or not. So it was a combination, but there was no direct reaching out from them or anything like that. So it went through Jefferies. And then we had asked them to set up a call with them.
Okay, so you did speak to them.
So
you did speak to the management before you.
Sorry, you broke up for a second. That's not what you're saying?
No. I did. So you approached them, is what you're saying?
Through Jefferies, yes.
Okay. All right. I mean, I just wanted to know, what's the India bet? Is now that there is a general risk off globally, are you say you always buy in a crisis? Are you buying right now and in India?
Yes, we are. In fact, we've been net buyers over the last X many days, weeks. I mean, after Adani, by the way, number of different things. So look, I think there are a few aspects. First of all, the India bet is kind of unique, and I feel that they're getting lost. It is not about buying consumer staples or IT services. Those are not really India bets anymore, in my opinion. perfectly good names, by the way, but not necessarily India bad. If you're an index hugger, you get paid to sort of mimic, or you can go massive underweight. I totally understand that. But we feel the real opportunity in India is the execution that you're seeing on the infrastructure side. That is the game changer in terms of what the implication, the multiplier effect that has. It almost sounds very similar to what China was, I remember 20, 25 years ago. So and by the way, these assets are utility assets. In fact, they're less to do with the India story in a way, because they're utility assets. The GDP growth would not impact them. So, in an ironic way, we're not making a bet on GDP growth, although I think it'll still be fine. But the real aspect versus a lot of things in Europe, and I'm talking as a global investor, which India is offering, is that interest rates are already high and inflation probably going to slow down over the next X many months and years, so on and so forth. There's no structural problem. Second thing is credit demand is very, very robust, and we feel it'll continue. The banking system is very, very clean. The third is that India is actually beneficiary of the geopolitical setup that is, which will help growth. But the most important one is the execution. If you look at, for example, road and railway construction now in India versus 7-8 years ago, is running at 5x versus what it was 5-6 years ago. Okay. If you look at, for example, the privatization, it's really, it's begun to sort of take shape, which will matter because that'll improve efficiency. If you talk to corporates, there's a general level of excitement. So we feel that India kind of stands out quite meaningfully versus not just other emerging markets, but even some of the other developed markets, especially in Europe.
Okay. But what's your view actually on the ongoing banking issues in US and in Europe? Do you fear that in US it could balloon into some kind of a contagion? How are you looking at risk assets, equities this year?
So, if you look at so far, and the problem is the banking systems, the sentiment or the confidence can itself be could snowball, could be vicious cycle or virtuous cycle depending where it goes. So if everybody believes there's a bank is gonna is gonna disappear, well, it could create a bank run and be a problem. For example, Credit Suisse, from a bottom of fundamental perspective, was not as poorly positioned, but you kind of have a banking run crisis because they're well capitalized. They raised capital just a few months ago, right? And this is a business where they do not have a non-performing loan problem. And they do have almost $500 billion worth of wealth management assets, which tend to be sticky assets, but now they've become leaky. So coming back to US, the problem so far is limited to Silicon Valley connection. If you look at the amount of frothiness you had in tech space in US and the rest of the world, frankly, I used to think that some of these venture capital firms are delusional. And Silicon Valley Bank has a long history of bad behavior. I mean, 20 years ago, I remember that they had issues because it's very pro-cyclical, linked to bad behavior in Silicon Valley. And Signature Bank, again, was tried to be a big driver in crypto. First Republic, again, very focused San Francisco. So it seems to be a very localized problem emanating from tech rather than a broad-based system. So to answer the question differently, no, we are not concerned about contagion risk.
Okay. So this could be still a good year for equities, you think? Or do you think if not contagion, you would worry about recession risk?
You know, if we're sitting at 2 months ago, I would be a lot more worried. We're actually getting less worried at the margin because I do feel that this pretty much means that Fed would have a tough time raising rates. I think the inflation picture should improve on a go-forward basis. And as you know, we have an inflation bear. So I think at the margin, I believe the outlook is beginning to improve, partially because the prices are down, partially because a lot of the things are sort of getting solved one way or the other. And if you take a 12, 18, 24-month view, the outlook has begun to sort of improve at the margin. Obviously, they're going to look at the stock and sector and countries, so on and so forth, which may be different for different places.
Okay. Well, thank you for making us feel so good, both a reassuring voice about the equity risk-off we saw over the last few weeks and about, the India story as well. You're sounding really positive. But I mean, you said that you are buying in India. What are you buying? Are you buying only utilities? Are you buying banks? What right at this point in time?
Yeah, it's a combination. So rather than saying what we are buying, I would rather say what we are not buying. The big sector that we have no interest in. I mean, staples, as you know. And by the way, we used to have like half of our global book in staples at one point. So I have a lot of sort of affinity with staples because we've actually done well in staples in the long run. So staples, IT services, We do like banks a lot, both public and private sector. Doesn't mean we're buying here and now, but we actually like those. But I think those are the. It's interesting if you look at the large index components, which are fairly widely owned by foreign investors and domestic investors. Generally, we are not finding much of interest there.
Okay. All right. But let me end with this. What you have told other media channels and us, that you buy into a crisis. You never waste a crisis. Okay. So which of your stock-wise risk bet didn't pay off? You pointed out that Infosys paid off, ITC paid off. So which didn't pay off? And would you admit that the Adani stocks are about one of the risky bets that you have taken?
You know, it's kind of interesting. I mean, there are a lot of names that haven't paid off, by the way. So I mean, we can sit here for 5 days. I can tell you every year that the things don't pay off, right? So I think that's easy one. I mean, in fact, we used to own a lot of state-owned banks in 20 plus years ago, and some of them worked very well, some didn't, because we actually had to take a basket approach. I mean, from Jammu and Kashmir Bank on, so they were basket approach. A lot of them worked very well, and a bunch of them didn't work, by the way. So there's a laundry list of them. I mean, if I remember the telecom space. In India, in the post-GFC, we had a significant exposure, and the regulatory sort of uncertainty, was created a situation where we actually had to cut loss and move on. This is 15 years ago, right? So there's name after names that haven't worked out. But I think Adani actually, I do not feel. Look, I mean, I'm sitting here and now, subject to change if data changes. We feel that these are still unique assets. I keep reminding everybody that. Yes. It is not a service-oriented business where I tell you something. There's a regulator in between. There's somebody's getting power, which is decided by a regulator. So we actually do not feel that as a very risky bet. And as I said, our typical style is we have a position.
The risk could be political. The risk could be political. The risk could be political. I mean, the risk could be political, isn't it? You must be seeing that in the Indian Parliament there is a demand for a joint parliamentary committee. So there is a political risk that you could be carrying.
I'm not so sure, because frankly, a lot of the allegations being made are total fluff. I mean, the Hindenburg report. I mean, if you go through the allegations and you verify one by one, the problem is most of the people are not doing that, right? So a vast majority are really not substantive.
Okay, fair enough. Okay, we will have to leave it at that because we're out of time, not out of questions. So let me take a rain check from you for another interview sometime soon. Thank you very much, Rajiv Jain, for spending time at CNBC TV18.
It was great to be here. Thank you.
Thanks. So, and with that, we wrap up this special edition of Newsmakers. Keep it with CNBC TV18. There are more news and updates lined up for you.